You and your partner have been renting for 4 years. You've saved up a solid down payment. Every family dinner, someone asks when you're going to stop throwing money away on rent. Your lease is up in 3 months, so you make a decision. It's time to buy. You find a $390,000 house you both love. 3 bedrooms, decent neighborhood, backs up to a quiet street. The lender says you qualify. Your agent says rates might go higher. Your parents say real estate always wins. You sign the papers. 2 years later, your friends of the ones who kept renting send you a screenshot. Their brokerage account just crossed $40,000. They invested every dollar of the difference between their rent and what a mortgage would have cost them. And you're looking at your equity statement, realizing you've paid over $60,000 in mortgage payments, and your principal balance has barely moved. That feeling is exactly what this video is about. Here's the thing. You didn't make a dumb decision. You made a totally normal one. The belief that buying is always better than renting is probably the most widely accepted financial idea in America. It gets treated like a basic fact. Your parents believe it. Your coworkers believe it. Half of YouTube believes it. And in some environments, in some decades, it was basically true. When rates were at 3%, prices were lower, and you plan to stay 20 years, buying was nearly always the right call. But we are not in that environment anymore, and nobody updated the script. The villain here is not you. It's a rule of thumb that stopped being universally true around 2022 and still has not been retired. Renting is throwing money away as the bumper sticker. But the math, the actual math, tells a more complicated story. And in 2026, for millions of American households, that story quietly favors renting and investing the difference. Let's run the numbers and see exactly why. Start with the home. $390,000, 7.1% interest rate, 20% down. That's a $312,000 loan. Your monthly principal and interest payment comes out to roughly $2,620. But that is not your housing cost. That is just the start. Add property taxes. On a home in this price range, the national average puts you at around $420 a month, though it varies significantly by state. Add homeowner's insurance, about $270 a month for a home at this price. Then add maintenance and repairs, which is the number people almost always underestimate. The standard rule of thumb is 1% of your home's value per year. Some years you'll spend less. Other years your HVAC dies, your roof leaks, or your water heater decides it's done. On a $390,000 home, that 1% averages out to $325 a month. Add it up, $2,620 plus $420 plus $270 plus $325. Your true monthly cost of owning this home is roughly $3,635. That's before any HOA fee and before PMI, if your down payment was less than 20%. Now compare that to renting something comparable. In the same market, a similar house or townhome rents for around $2,100 a month. That's the going rate in many mid-size metros for equivalent square footage and neighborhood quality. The monthly gap is $1,535. If you take that $1,535 every month and invest it in a broad index fund, returning 8% annually, over 7 years you accumulate roughly $176,000. That is the opportunity cost of buying instead of renting in this scenario. That number almost never shows up in the rent versus buy conversation. It should, every time. For the home buyer to come out ahead, their home needs to appreciate enough to overcome the money that did not go toward principal. Over 7 years at these numbers, you will pay roughly $228,000 in total mortgage payments. A significant portion of that is interest, not equity. Add in maintenance, taxes, and insurance on top of that, and your break-even point requires solid appreciation just to keep pace with the renter who invested the difference. That appreciation may happen, it may not. It is not guaranteed. Here is what this actually feels like from the inside. You are not struggling. You have a house you love. But every month, your take-home feels tighter than you expected. The mortgage is predictable, but then the water heater goes. Then the driveway needs work. Then you find a drainage issue in the basement. Your housing costs are locked in at over $3,600 a month, and you cannot easily downsize when life gets complicated. If you sell transaction costs alone, agent commissions, closing fees, transfer taxes, typically runs 6 to 8% of the sale price. On this home that is another $23,000 to $31,000 off the top, money you have to earn back before the appreciation math even starts working in your favor. Your friends who kept renting moved to a cheaper place when one of them changed jobs. Their rent dropped $400 a month. They put that $400 in their brokerage too. Their financial life flexes. Yours does not. Not right now. None of that makes buying a catastrophe. But it does mean the math was never as clean as buy equals win and rent equals waste. Here is what I want you to hear clearly. There is nothing wrong with renting. Nothing. Renting buys you flexibility, lower upfront capital requirements, and in today's rate environment, it buys you something else. The ability to invest the difference and build wealth at a competitive pace. This is not anti-home ownership. Buying makes sense in certain markets, at certain price-to-rent ratios, with a long enough time horizon and stable enough income. For a lot of people in a lot of situations, buying is still the right call. But the decision deserves honest math, not social pressure, not the fear that renting makes you a failure, and not a rule of thumb from 2003. If the numbers in your market do not work, renting and investing the difference is a legitimate, mathematically sound wealth-building strategy. It always was. We just forgot to say it out loud. So here's what you can do this week. First, calculate the price-to-rent ratio for your target market. Take the home's purchase price and divide by the annual rent for a comparable property. If that number is above 20, renting and investing the difference is likely the stronger financial move at current rates. Below 15, buying starts to look competitive even in today's environment. Somewhere in between is where you have to do the deeper work. Second, build the full cost stack before you compare anything to rent. Mortgage principal and interest, property taxes, homeowner's insurance, and 1% of purchase price for maintenance. That is your true monthly ownership cost. Compare that number to your rent, not just the mortgage payment. Third, calculate what the monthly difference could become if you invested it. Use any compound interest calculator, assume roughly 8% annually, and plug in your realistic time horizon. That number is the opportunity cost of buying. Put it in the comparison every time. Fourth, factor in your timeline seriously. If you are confident you will stay in the home for at least 7 to 10 years, the math can shift meaningfully in the buyer's favor. Appreciation and principal paydowns start to accumulate enough to overcome the cost gap. If there is any real chance you move in 5 years or less, transaction costs alone will erase a significant portion of your equity gains. That is a major strike against buying in the current environment. Fifth, separate the financial decision from the life decision. If you want to own a home for stability, space, roots, or control over your environment, those are real and valid reasons to buy. Just be honest that you are paying a premium for those things right now, not automatically making the superior financial move. Both can be true at once. The average person makes the rent versus buy decision based on what feels right and what everyone around them is doing. They skip the full cost math. They do not run the opportunity cost. They do not check the price to rent ratio. They just buy because that is what you are supposed to do. You do not have to be that person. The people who actually build wealth are not necessarily the ones who bought the house. They're the ones who ran the numbers, made the decision that fit their market and their timeline, and did not let a cultural assumption override their math. If that kind of thinking is useful to you, subscribe. This channel is for people who want to actually understand their money before they make the big calls, not just feel confident about them.